Today, I want to break down something that might sound boring at first, but trust me, if you run a business, freelance, or just want to get smarter with your money, these are the 5 accounting principles you absolutely need to know. And I promise, by the end of this video, you'll see your finances in a whole new light. Have you ever tried to do your own books for a side hustle and thought, how hard can it be? Fast forward to tax season and you're staring at a mess of receipts, bank statements, and random notes. It's not just about tracking what comes in and out. It's about trying to have a system. That's where these accounting principles come in. They're not just for accountants. They're for anyone who wants to make sense of their money. So let's jump in. I'll break this down into 5 sections, each focused on a key principle, with real-world examples and some tips you can use right away. First up is double-entry bookkeeping. If you only remember one thing from this video, make it this. Every financial transaction affects at least 2 accounts. For example, if you buy a laptop for your business, your cash goes down, but your equipment goes up. It's like a seesaw. Everything has to balance out. This system is why accountants talk about debits and credits. It's not just jargon. It's a way to keep your books honest. If your debits don't equal your credits, you know something's off. I once caught a huge mistake in my own books just because things didn't balance. So even if you're using an app, try to think in pairs. Every action has a reaction. If you're new to this, try tracking your next big purchase or sale with 2 entries. Next, let's talk about how you record income and expenses. Accruals versus cash accounting. This one tripped me up for years. Here's the difference. Cash accounting is simple. You record money when it actually moves. You get paid, you write it down. You pay a bill, you record it then. Super straightforward. Great for freelancers or small businesses. Accrual accounting is a bit more advanced. You record income when you earn it and expenses when you incur them, even if the cash hasn't changed hands yet. So if you send an invoice in June, but get paid in July, you record the income in June. So why does this matter? Accruals gives you a more accurate picture of how your business is really doing, especially if you have clients who pay late or buy inventory up front. Cash accounting is easier, but can make your profits look lumpy or misleading. Personally, switching to an accruals perspective has helped me spot months where I was busy but not actually making money. If you haven't already, try tracking a month using both methods and see the difference. The matching principle is one of those ideas that sounds technical, but it's really about fairness. It says, match your expenses to the revenue they help generate in the same period. This helps you see the true cost of making money. I used to record expenses whenever I paid them, but that made some months look terrible and others amazing. Once I started matching costs to the right period, my numbers made a lot more sense. Try this next time you have a big project. Track all the related costs and income together. You'll get a much clearer sense of your real profit. Let's talk about depreciation. If you buy something big for your business, a laptop, a van, machinery, you don't just count the whole cost as an expense right away. Instead, you spread it out over the item's useful life. This is called depreciation. For example, if you buy a £900 laptop and expect to use it for 3 years, you record £300 as an expense each year. That way, your profits aren't skewed by big purchases, and your books reflect how assets lose value over time. Depreciation essentially smooths out your expenses and gives you a more accurate picture of your business health. If you've made a big purchase recently, try calculating its annual depreciation. It's a great way to understand how your assets impact your bottom line. Finally, let's tie it all together with the financial statements. These are the scorecards of your business or personal finances, and they're built on the principles we just talked about. There are 3 main ones you should know. The income statement. This shows your revenue, expenses, and profit over a period. Think of it as your how much did I make report. Then there's the balance sheet. This lists what you own, assets, and what you owe, liabilities, and also what's left over, equity, at a specific point in time. And then finally, the cash flow statement. This tracks the actual movement of cash in and out, so you know if you can pay your bills, even if your income statement looks great. If you haven't looked at your financial statements lately, pull them up and see what story they tell. So to recap, double-entry bookkeeping keeps your records honest. Accruals versus cash accounting changes how you see your money. The matching principle helps you see true profit. Depreciation smooths out big purchases. And financial statements turn all that data into insight. If you take one thing from this video, let it be this. Understanding these basics isn't just for accountants. It's for anyone who wants to make smarter decisions with their money, whether you're running a business, freelancing, or just managing your household budget. Thanks for watching, and I'll see you in the next one.